Well, what a day. We started in the morning with Shopify earnings and now with Nvidia after the market close. Hello everyone, welcome back to the channel. In today's video, I will talk about Shopify earnings, why the stock dropped 17% after they reported, and what have been happening with Nvidia as well. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. As we can see, Shopify was down 16% during the day. We can see this huge drop here as we see after they reported earnings. It dropped 18.7% and it recovered a little bit, so it is down 16.04%. But still, the stock is down 47.59% in the past year. As we can see that here where it peaked back in November, it has been dropping 55% since then, because in my opinion, to be honest, it was getting really overvalued, and now at this price is really attracting. Still, it is up 1,114% in the past year. I'm not investing in it, but I'm saying that it's really attractive for me. It's currently trading at $739 per share, which is down 1.05% after hours, with a market cap of $89 billion, with a 52 weeks low of 720 and a 52 weeks high of $1,700 per share, meaning that we are really near to what it was their lowest point in the past year. Now, Shopify stock closed down 16% after once pandemic boost will fade, which, to be honest, is something that we should have expected before. We're going to talk about that later. Now, they blame a deceleration in e-commerce spending compared to the high of the coronavirus pandemic, along with other factors like the end of government stimulus and potential impacts on consumer spending due to rising inflation, which is something that we have seen that have been affecting many companies, not only Shopify. For the fourth quarter, Shopify posted a revenue of $1.38 billion, which surpassed the $1.34 billion estimated. And they reported $1.36 per share in comparison to $1.27 expected. Still, Shopify said revenue growth for 2022 would be slower than the 57% they had in 2021. Now, e-commerce companies like Shopify, Etsy, eBay, and Wayfair are under intense pressure to prove their business can continue to grow in post-pandemic world, which is completely normal. We have already seen that with all of the other e-commerce companies, including Amazon. They had huge growth during 2020. They had a lot of clients. The growth of their clients were incredible, and even for Shopify as well. And now in 2021, they were not able to see that huge growth of over 100% that they were seeing in 2020. And obviously will not continue seeing that growth in 2022, as the economy is almost fully open. People are working, are not earning as much money as before. We have a problem that's called inflation, and also there are not that much stimulus anymore on the streets. But we can see that obviously we see that their earnings were good. So what really happens? Because we saw that the total revenue grew 57% year over year. Their gross profit grew 61% to $2.4 billion. Their adjusted gross profit 60%. Operating income was 6% of their revenue in comparison to 3% of 2020. But I do have to say, we can see that the revenue grew 41.1% year over year, from $977 million to $1.3 billion in the past quarter. Their gross profit grew 37.33%. So that's the first problem, as we see that their cost of revenue increased at a faster pace than their revenue, as their gross profit was less than their revenue, for 37% growth in comparison to 41% growth. The thing is, when we see this income from operations decreased 87% from $112 million to $14 million, even though we saw that their revenue grew 41%. So what happened? We can see here that, first of all, their sales and marketing grew 78%. And that's something that not many people like to see, that they're spending way more money in sales and marketing, but they're not seeing that same kind of growth in their revenue, because basically they're burning that money. But I do have to say that the second half of the year is always way more expensive for companies to attract more clients or more customers than in the first half of the year. Also, we have more competition, so that might be increasing the cost of attracting new customers and new clients to their platform, as we have more and more competition at the moment. And that's why they might have expended this much money, $275 million in sales and marketing. The research and development grew 72%. Their general administrative is 54%, and transaction and loan losses was 110% if I'm not mistaken. So that's what, in my opinion, people did not like from this review, from this earnings report, because they saw a nice growth of 41%. Because if we check here, we can see the growth that they have been having over years. They were at 44% in 2019, 44% in quarter 4, 46% in quarter 3 2020, in quarter 1 2020, then 97% was when the growth started in the second quarter of 2020, 96% for the third quarter, and 93% for the last fourth quarter of 2020. Obviously, they saw a huge growth in first quarter of 2021, but that growth has been slowing down since then and kind of getting to a normal state for them as it was in 2019 of about 40%. So it was a 56% for the second quarter and 46% for the third quarter, but now for the fourth quarter was 41%. The thing is that they are not expecting that growth to continue in the next year. And obviously, even though it was kind of expected, investors did not like that a lot. Plus all the expenses growth that they saw, which obviously is not a good sign. I do have to say that is something I'm going to have in mind for their next earning, as I'm not investing in it, but it's something that attracts me a lot, because the e-commerce industry is something that I see a lot of potential, and I believe Shopify still has a lot of potential. Now, Nvidia stock just reported earnings. At the moment, it is down 1.90%, even though it was up 0.06% during the day. Year to date is down 11.98%, and in the past year is still up 77.85%. In the past 5 years, 888%. At the moment, even with this huge drop of 30% since November 2021, which was when the market peaked. So Nvidia provides strong revenue outlook on demand for computer chips, which is actually a good news for all this chip shortage problem that we have been having in the world during 2021, and all the supply chain issues and more. Nvidia reported fiscal fourth quarter on Wednesday. Data center sales rose 71%, and Nvidia has been boosted as cloud providers, because we can see here that they reported an earnings per share of $1.32 in comparison to $1.22 expected, which is up 69% year over year. And their revenue was $7.64 billion in comparison to $7.42 billion expected, up 53% year over year. They said that it expects to report $8.10 billion in the first quarter, higher than analysts' expectations of $7.29 billion, meaning that it will not only beat analysts' expectations, but will also beat what they reported last quarter, quarter 4. Nvidia CEO said in a statement that the company is seeing exceptional demand because its chips are useful for artificial intelligence and other intensive applications. Now, Nvidia reported $3.26 billion in sales from data center, which is up 71% annually, as I said before. And Nvidia has been boosting as cloud providers and enterprises turn to the kind of graphics processors Nvidia makes for artificial intelligence applications such as speech recognition and recommendations. During the quarter, Nvidia announced that Facebook parent Meta would use its chip for artificial intelligence research, for example. And that is actually excellent news, as we know that the cloud business is something, the cloud industry is something that has a lot of potential long term, and them being boosted as a cloud provider and enterprises to turn the kind of graphic processors to artificial intelligence is very important, as we know that that is basically the future, and even more with all this metaverse thing going on. And now, for the gaming is still Nvidia's largest market, as its latest GeForce graphic processors are ideal for playing advanced computer gaming. And the only thing is that Nvidia chips are also ideal for professionals who need them for advanced applications like computer and more. However, Nvidia's automotive business was down 14% to $125 million. It's not a primary focus for the company, but represents a growth market for its chip. So it's something that we want to see a growth in the coming quarters. Last but not least, Nvidia said that nearly all of its GPUs now ship with software that prevents them from being used to mine cryptocurrencies. It said it sold 550 million in crypto-specific cards in the fiscal 2022 and only 24 million in the fourth quarter. Last but not least, guys know that they were almost going to purchase ARM, which is a chip technology company from SoftBank, but that deal didn't go over as it had fallen apart under regulation scrutiny. So, in my opinion, they did well. They had an excellent growth year over year, 53% in revenue, 69% in their earnings per share. As you guys know that I like to see their earnings growing at a faster pace than their revenue. They had a nice their cloud providers is excellent, and the Nvidia's chips is very good news as well. Right now, I believe that Nvidia is a very nice company. It has always been. I do have to say that I don't invest in it, even though it's down 30.76%. I am not investing in it at the moment. I do have to say that these two companies are very, very interesting. These two earnings were very, very interesting and really different as well. If you invest in any of these companies, let me know in the comment section below and what you think about this earnings report. Thank you and see you next time.